Hey YouTube, Peter here. I want to do another video reiterating what I think is going to happen in Asia. I've been reading more and more about it, and it's pretty scary. Really what's happening is these emerging markets have been buying all the US treasuries for the past few years. I don't want to bore you with a bunch of numbers, but basically they own about 2/3 of the treasuries. All this money that's been printed, people are surprised that we haven't turned into a Weimar Republic yet, that there hasn't been hyperinflation. But basically what's going to happen soon, I believe, is that as the economies in Asia, which hold all this paper, as they start to flounder, they're going to be selling it, which is going to bring all that money out of the central banks, and it's actually going to put it into the economy, and it's going to create hyperinflation. And I'll link two articles that I've been reading here that explain it very, very well. Article, it says, if for example China suddenly discovered the $2 trillion dollar hole in the balance sheets of its banking system, since all the empty office buildings and apartment buildings constructed in 2008, 2010 are worth very little. And I've seen that with my own eyes here in Thailand. There's just tons and tons of vacant space, as well as huge malls. If you go to Bangkok, basically in every subway station that you get off, there's a humongous mall. There's even one that's called Siam Paragon, and I'll link it to you. And I might do a video when I go to Bangkok about it. And really, I've never seen anything like it in the United States. It's amazing. They have every Italian brand name that you can think of in there, including Gucci, Armani, Maserati, luxury cars, everything. I mean, I've never seen a mall like it in my life. I'm just saying that the amount of building and money that they've been pumping into Asia in the past few years is just phenomenal. But there's a lot of malinvestment. Its natural response would be to sell $2 trillion worth of its $3.2 trillion of foreign exchange reserves, perhaps $1.4 trillion of which sales would be in the form of U.S. Treasury bills and bonds and housing agency bonds. It would then give the money to its domestic banks and plug the holes in their balance sheets. The banks would use the money to pay bills and refund depositors, pushing it into the global financial system. This would have two effects. First, there would be an additional $2 trillion of money in the world economy in the form of transactions, as the Chinese banks spent their lifeline. Second, the U.S. Treasury and the housing agencies would suddenly have to find $1.4 trillion worth of additional buyers for Treasury and agency debt. Even if the Fed is still at that point buying $85 billion of debt a month, interest rates would rise sharply. Overall, the U.S. economy would not only suffer much higher interest rates, causing a substantial recession and a stock market crash, but also a sharp burst of double-digit inflation as the extra active money fed into prices. This would be retribution for the misguided monetary policy since 1995 and fiscal policies since 2001 suffered all at once, and it would be very painful. It's like what I've been saying, they've been kicking down the can down the road for so long. And I think this is going to be the trigger that's going to set all of these dominoes into action. So I'm telling you, just keep watching Asia. In practice, it's unlikely the Chinese government would choose to recognize its $2 trillion bad debt problem all at once, but basically, you're having a lot of countries that are in this situation, not just China. Okay, then it goes on to say the spend down of central bank reserves will thus happen simultaneously in a number of countries. It will both place an immense strain on the U.S. Treasury market and bring a wholly unexpected and substantial surge in inflation, which will quickly reach double-digit levels. Countries that have overexpanded their money supply, notably the U.S., Japan, and Britain, will find themselves suffering a double-edged problem of sharply rising interest rates and virulent inflation. It's what all the economists and preppers have been talking about for years, that hyperinflation is coming. So, store your food, buy your gold right now, if you haven't already. And if you have already, it's time to get more. This time around, in previous recessions, credit crunches of this kind, even without the inflation, have been especially cruel to emerging markets. One only need think of the deep recession suffered by Mexico in 1995 and the East Asian countries in 1997 and 1998. It's like what I'm saying, it's just a replay of the Asian crisis. Okay, and then I have this other article here. Investors need to get real about China's slowdown. And it goes on to say that a lot of people aren't taking it seriously. But when you really delve into the numbers, that it's a lot worse than it actually is. It is true that at first glance the mainland's economic slowdown appears relatively modest. After all, growth only dipped to 7.5% in the second quarter, down from a 10-year average of 9.6%. A drop of just over 2 percentage points hardly looks like the end of the world, but the apparent shallowness of the slowdown is misleading. That's because the deceleration to 7.5% refers to the slowdown in real growth, that is, growth in GDP, adjusted for inflation to give a consistent measure over time. But the slump in nominal growth, that is, the unadjusted growth rate, has been far more severe. In the second quarter, nominal growth fell to 8%, down from a 10-year average of almost 16%. The drop has been so pronounced because of a steep fall in economy-wide inflation. Unlike the consumer price index used to calculate everyday consumer inflation, the GDP deflator takes into account prices right across the economy, from raw materials through components entering factory gates to accounting services, as well as the price of goods in consumer shopping baskets. Basically saying their analysis shows that there's been a huge slowdown in China. As a result, the first chart shows the mainland's nominal growth has plunged more than half in the past 18 months. So, I don't know if you heard that. The growth in China within the past year and a half has plunged by more than half. I mean, that's a huge drop. And, the mainstream media really isn't talking about it. And it's something you really need to keep on your radar.